China has just done something that is set to change the global economic landscape for a very long time. And if you are not paying attention to what is happening right now, one day you may wake up asking yourself how we arrived at a completely different world without anyone clearly explaining it to you. We are talking about a decision that the United States had been watching with concern for decades, a move that strategists in Washington had anticipated for years, and China finally carried it out. It sold U.S. Treasury bonds in very large amounts. Now, I know that for many of you this may sound like boring financial language, like something that only matters to bankers on Wall Street or officials at the Treasury Department. But let me be absolutely clear with you. What just happened is far more important than any recent election, any political speech, or any newspaper headline you have seen in recent months. This is a major shift in the foundations of global economic power, and its effects are going to influence your life, your job, your savings, and your future, whether you choose to follow it or not. Let me explain exactly what this means and why you should pay close attention. For more than 50 years, since Richard Nixon ended the gold standard in 1971, the United States has operated under a system that I and many other critical economists have called the exorbitant privilege of the dollar. This is not a balanced system, and it is not a system based purely on merit. It is a system built on a very large structural advantage that allows the United States to live far beyond its means, while much of the rest of the world carries a significant part of the cost. This is how it works. The United States prints dollars. Those dollars are accepted globally as the world's reserve currency, which means all countries need dollars to trade with each other, to buy oil, to build reserves, and to protect themselves during crises. And because the world needs dollars, the United States can issue this currency without facing immediate and obvious consequences. It is like having a money printer in your basement while all your neighbors agree to accept that money as valid payment. No matter how much you print, no matter how careless you are with your personal finances, you can always create more money, and someone will accept it because everyone depends on that system. Now imagine that one day your biggest neighbor, the one with the most successful business in the area, the one who has been accepting your printed money for decades, suddenly says, "You know what? I do not want your money anymore. I am going to use something else. I will use gold. I will use my own currency. I will trade directly with other neighbors without going through you." That is essentially what China has just done, and the implications are truly enormous. But to really understand why this matters so much, we need to go deeper into how this system works and why it is not sustainable over time. I have spent decades studying capitalism, its crises, and its internal contradictions, and I can tell you that the current system of the dollar as the world's reserve currency is one of the largest economic distortions in modern history. It allows the United States, a country that represents less than 5% of the world's population, to consume close to 25% of the planet's resources. How is this possible? Because the United States can finance massive trade deficits year after year, decade after decade, simply by issuing more dollars or selling more dollar-denominated debt that other countries buy. Think about it this way. If you and I spent more than we earned every month, eventually our credit cards would be maxed out, banks would stop lending to us, and we would face serious financial trouble. But the United States has been spending more than it produces for more than 40 consecutive years, building up enormous trade deficits, and instead of facing immediate consequences, the rest of the world has continued to finance that lifestyle by buying U.S. Treasury bonds. China has historically been the largest foreign buyer of these bonds. At its peak, China held more than $1.3 trillion in U.S. Treasury securities. That is $1.3 trillion. To put that into perspective, that is more than the entire GDP of countries like Mexico or Indonesia. In practice, China was lending the United States extremely large amounts of money, and the United States was using that borrowed money to fund its extensive defense system, to finance military operations in places like Iraq and Afghanistan, to support tax cuts for wealthier groups, and to provide support to large corporations. So the obvious question is, why would China do this? Why would it finance its main geopolitical competitor? And this is where many traditional analyses fall short. They will tell you it was a mutually beneficial relationship that both sides gained. The United States received cheap financing for its deficits. China gained access to a huge market for its exports. Chinese workers produced goods that American consumers bought with borrowed money, and that money flowed back to China in the form of dollars that the Chinese government invested in Treasury bonds. A seemingly positive cycle, they say. But that explanation hides a crucial power dynamic. China did not have many real alternatives. When a country runs very large trade surpluses with the United States, it accumulates dollars, and those dollars have to be placed somewhere. You cannot simply let them sit idle. You need to invest them. And for decades, the largest, most liquid, and seemingly safest option was U.S. Treasury bonds. It was the only market deep enough to absorb the massive flows of dollars China was generating. However, there was a serious weakness in this system that China came to understand more clearly over time. By holding so much of its reserves in U.S. Treasury bonds, China was making itself highly exposed to U.S. financial power. If Washington decided to freeze those assets, China could lose access to more than $1 trillion of its national wealth. If Washington decided to issue very large amounts of new dollars through expansive monetary policies, the real value of China's holdings would decline. If Washington chose to use the financial system as a tool of geopolitical pressure, something it has done repeatedly with countries like Iran, Venezuela, Russia, and Afghanistan, China would be vulnerable. And here is the key point I want you to understand. China watched very carefully what the United States did to Russia after the conflict in Ukraine in 2022. Washington froze approximately $300 billion of Russian central bank reserves. Russian. Read that again. The United States and its allies effectively took control of $300 billion in the foreign reserves of another country. No matter what you think about Russia or the war in Ukraine, this was a defining moment in global financial history. It showed, without any doubt, that dollar-based assets, even central bank reserves that are supposed to be protected within the international financial system, can be frozen, held back, and used as a tool of pressure if a country challenges the interests of the United States. Now put yourself in the position of strategists in Beijing. You hold $800 billion, until recently more than $1 trillion in U.S. Treasury bonds. You know the United States sees you as its main strategic competitor. The Pentagon has clearly identified China as its primary challenge. The United States is building military alliances in Asia specifically to limit China's influence. It is placing tariffs on Chinese goods, restricting technology exports to China, and constantly talking about defending Taiwan with military support. And at the same time, you have $1 trillion of your national wealth in assets that this same country can freeze with an executive order. What would you do? The answer is obvious. You would reduce exposure, diversify, and look for alternatives. And that is exactly what China has been doing, not in a rushed way, not in a chaotic way, but in a methodical, strategic, and calculated manner. Data from the U.S. Treasury Department shows this trend very clearly. China has been selling U.S. Treasury bonds consistently for years. From more than $1.3 trillion at its peak, it now holds less than $800 billion. That is a reduction of over $500 billion. $500 billion that is no longer financing the U.S. deficit. $500 billion that China has shifted into other assets, other investments, and other forms of value storage. And China is not alone. Japan, historically the second largest holder of U.S. treasuries, is also reducing its positions. Saudi Arabia, the country that signed the petrodollar agreement with the United States in the 1970s, is diversifying its reserves and is considering selling oil in yuan. Central banks around the world are buying gold at rates not seen in decades. Russia has reduced almost all of its holdings of U.S. Treasury bonds. India is accumulating gold. Brazil is making trade agreements in local currencies. The entire system that kept the dollar at the center of global trade is slowly weakening, and most people do not even notice because mainstream media is too busy talking about what some politician posted online or the latest celebrity scandal. Now let me anticipate the argument from defenders of the current system. They will say, "Richard, this doesn't matter. The United States will always find buyers for its bonds. The dollar is too big to lose its position. There is no real alternative. China would hurt itself if it sold all its bonds because it would damage the value of its own holdings." On the surface, these arguments can sound convincing, but they fall apart with even modest scrutiny. First, the claim that there is no alternative to the dollar.